Go ahead and start it. We're still going to wait a minute for people.
Okay, no problem.
All right, I'll talk to you in a while.
All right. Guys, we're just going to wait a couple more minutes here. And
James? Hi, James.
yes.
You mentioned the other meeting that you have a picnic on July 28th. Is that for Oregon team only?
Let me check things here for you, okay? It's not July 28th, it's July 20th. It's July, just so, because there's other people from other areas, July 19th is in Albany. That's mostly for your southern part of the district. And then on July 20th, that's a Saturday from 12 to 3. That's for the greater Portland area. Does that answer what you're asking?
Yeah, because I know we have also a picnic in Vancouver.
Oh.
But well, I don't know when.
No, I'm not sure what Vancouver's about. That's got to do with Lloyd. If you're talking about the other Jackson Hewitt up there, yeah. No, we're not coordinating with him.
Okay.
They're on their own, so.
That's fine, yeah.
Yeah. Okay. So.
Where it will gonna be yours?
It's going to be at the one in Albany is going to be at the Albany Training Center. The one at Portland is going to be at the Start Training Center.
Okay.
You know, the main office in both locations. Okay?
Yeah.
Yeah, but keep in mind, you said the 28th, and it's not the 28th, it's the 20th.
Yeah, 20, yeah.
Yeah, 20, okay. All right, so I am pulling up what we need here. Sorry about that. I was actually dealing with some other training. So I'm going to get these pulled up for you right now. I'm also sending out a 6-page document to everyone here in just a moment. It's in PDF format. I'd like you to go ahead and save this and print it out. This is what we're working from today.
Okay.
Good morning.
Good morning, Garrett.
Sorry I'm late.
It's all right. We're off to kind of a slow start this morning anyway. All right. So everyone has this. You should have it now. Everyone can see it?
The Affordable Care Act?
Yes, Affordable Care Act. That's what we're going to be talking about today.
Yeah.
So go ahead and download that. And everybody, I think it would be a good idea to print it out if you can, because that way you'll be able to make notes on it, because that is what we're working off today. Okay? So let me know when you have both those done. Okay, so Tina, Garrett. Okay, so Garrett, you're the only one that has not told me if you got it done yet, and that's okay if we're still waiting. This is important to have.
Sorry, it's done here.
No problem. Sorry, guys, I'm reaching out to one of our students that should be with us today. All right. We're not going to wait for them, but all right. So let me go ahead and start sharing my screen so you can see what I can see. Okay. Get the right document up here in the right spot. Okay, so all right. So we're working off of this 6-page document today. We're going to see how fast this goes. I'm certain we're going to get through the Affordable Care Act today. There's another part we might jump into, and once we, we'll see how far we get today. Okay? Because we're still trying to wrap up a few odds and ends that we need to wrap up for you. Because you know we're getting near the end, right?
Right. Yes.
Okay. Also, the other thing, has everyone now been practicing, gotten their online, in other words, purchased the online passkey?
Yes.
Okay. Really, really need to do that because that's the thing that's going to help you pass these exams. It's the question bank that we really need. Plus, we have discovered that if you do the $40 version, you have the current updated version of this book that we thought we had. They sent it to us, but they did not send us the updated version. Just go there and download it. You could download a copy of it. It costs a little bit of money, but you know, for 3-4 months of investment, it's going to get you a long ways. Because here's what's going to happen, and this is what we're anticipating at this point. We're anticipating having to finish this process up in about a week of teaching for part 1. Then we're going to do a couple of review sessions where we're going to kind of use it as study hall, a chance for all of us to get together, ask questions, recap certain things. And then, guys, you're on your own to go take the exam. Now, we did say we'd pay for your first attempt at each part of the exam. We're going to do that. But here's the point, is you still need to be prepared for that, because we're not going to pay for it till we are convinced with our paper and pencil tests that we're going to give you that you're ready to take it. How are you going to get ready? By taking those quizzes online. And where are they? They're at Passkey. They're the ones that have the ability to have numerous hundreds to thousands of questions available that we don't have. And that's why we're having to kind of partner, if you will, with them to get this done. Okay, so you've got to go on and sign on. So I'm preaching at you a little bit. Sorry about that, but we really do want you to succeed. So what I need from you, and I need to clarify, this is what we need for each chapter or unit of reading. There are some online questions. We need you to go through those questions over and over again until you start getting 2 or 3 quizzes in a row for each chapter at 80%. Then move on to the next chapter. Once you've gone through all the chapters, getting 80%, you know, on 2 or 3 quizzes, then take some practice exams on there and make sure you can get, and you can do them and redo them till you start getting 80%. Once that happens, you need to let us know. We're going to give you paper and pencil tests. It's just our way to say it, to find out if you're ready. And if we think you're ready, then we're going to go ahead and help you get signed up to take your first exam. But do know, in about 2 weeks, we're going to be starting the training for part 2. We cannot afford training-wise, teaching-wise, to stop moving forward. We can slow down a little bit for you, but we know that for some of you, you're going to still be trying to get ready to take that part 1. So don't feel overwhelmed by that. because it's nothing to get overwhelmed by. Part 2 is going to move slower than part 1 is moved. Because it's new material for most of you, it's going to be new material. So it's all going to be brand new. So we're going to teach it at a slower pace. We've taught this at a quicker pace because most of you have been exposed to this material, and we figured the individuals that had not before could slow themselves down and just watch the videos later, these webinars later. Okay. So
James,
yes.
hope in part 2 you will get the latest material like
You're gonna
what
we're
what's in the passkey.
but you can get it yourself right now if you just get what I'm trying to tell you guys is I want you to hear this. We'll get the material for you, but I want you to hear this. If you cannot just read the book, do a few questions that are at the end of each chapter in the book, and watch the presentations, you're not going to pass if that's all you do. You've got to do the question bank. The question bank is going to make the difference of you passing or not passing. So while we're going to get you an updated book, and that's fine, we're asking you, please, for your sake, go and put in that at least $25 a month to get the question bank. I'm encouraging $40 a month, and I'll tell you why. The extra $15 gets you access to not only the most updated material that they're always updating a little bit, but it also gets you access to other presentations by other people, other explanations, things like that. And we're only talking 3 or 4 months worth of investment. So we're not talking more than $120 investment over a 4-month period, even if you went with a more expensive one.
Yeah, I got the 40, but what I mean, I hope you understand me. For part 2, I hope you will discuss to us what is in what I got, the 40.
Oh, you mean the 2018 material? Is that what you mean?
Yeah, the latest.
Yeah. Actually, Ryan will be teaching that, and he's been working with that. He's had more time to update that stuff. I had to update mine in about 3 weeks. I had to put mine together fast, so he's been working on his. It should be ready.
Yeah,
he's told me it's ready to go. Yeah, I got you now.
Yeah.
So what about everyone else? Is everyone else online? I kind of want to know where people are at right now.
I got signed up with Passkey Wednesday.
Okay, perfect.
And I haven't figured out how to download the book. I can actually go through and read it there, but I didn't see a way to actually download it or print anything out. So I'll have to play with that some more. But
okay, I thought you could. I have not seen it, and you and Ryan.
Well, they offer it for sale. The book's for sale on Amazon for like each individual session. The first one, the second one, and the third one for like $50 each. And
I got you.
Oh, really?
I didn't want to. I mean, I was already paying for the
other thing.
Class, so I figured why buy the book. So, but
no.
I thought if they're selling the book separate, they may not make it available to download.
That's what makes me nervous. That's what makes me nervous is that's what Ryan had purchased, and we thought we had gotten the 2018, even though it said it on the cover, it wasn't. So, yeah.
Well, their website said that they just updated it in June because there was a delay because of the shutdown earlier this year.
Okay.
Whoever's office
guys, if you
didn't get it updated.
You can buy an updated copy of this book. You can buy an updated copy. You could reach out to Garrett and get Garrett's help with that. I'm sure Garrett would be glad to help you if you want to.
It's available through the passkey. I mean, that was an option to look it up to purchase it from.
Okay, so get on passkey.
Right on passkey, so.
Get on passkey, and then you'll be able to purchase it. All right, so Garrett, you got it. Amanda, do you have it? Do you have the online?
I do, the passkey.
Yes.
Yes.
Wonderful. Wonderful. If anybody, by the way, does figure out how to do an electronic version of the book, it might not be available, but if they do, let us know. So, Noemi, did you say you do or do not have access yet? I can't remember what you said.
I already got it.
You already got it. Okay. And Sheila, how about you?
Got it.
Perfect. Okay. All right. Good enough. And Tina, I know your situation's a little bit different. I know you're not really studying. Tina's here to more get part 1 training, and so that's why she's participating in this. Although she might decide to go with part 2, she hasn't made a final decision yet, but it's up to her. So, but if you do, Tina, I'd ask you to also get that as well. All right. All right. So today, mostly we're focusing on the Affordable Care Act. Okay. Let's talk about this, and then I'm going to show you how it fits into the Form 1040. Okay. So the Affordable Care Act, there's 2 parts to it, and we're going to talk about we're going to kind of break them up into 2 parts here. So let's start here. Everyone is required to get health insurance. That's the basics of the Affordable Care Act. In theory, the concept was if everybody was forced into the market, that would drive down the prices because there would be more competition. And so that was the theory behind this. So
Jim?
Huh?
Question?
Yeah.
It's no longer required for the 2018 tax season.
Yeah, it is for 2018. It is required. You still got, when you did a 2018 return, people were still required to have it. In 2019 is when it's no longer required.
Okay. All right.
Yeah, and it is still required. The law didn't change. It's just the president did an executive order in I'm trying to remember. It would have been, I forgot when he signed it, but there was an executive order that said they were not going to enforce the penalty. That's what they did. So the law is still in existence. He just used an executive order to tell IRS not to enforce that part. However, we thought it was going to go into effect in we thought it was going to go into effect on in 2018, but it ended up not being in 2018.
I see. Thank you for clarifying.
Yeah, no problem. Oh, Amanda, you didn't get this document? Okay. Let me send this out again here, okay? There it is.
Thank you.
And just to let you know, it is exactly the same document that's up here. This is just for your guys' convenience that you can see it on the screen, but have a copy for you to make notes on.
And I'm doing a lot of catch up. Yeah, thank you.
Yeah, no problem. So it is still a requirement for 2018, and since that's what we're focused on, no in 2019, unless something changes, but I doubt it. While the law still exists, the penalty part is not going to be enforced, but we haven't quite got there yet. Still, by the law, everyone's required to have health insurance, okay? And the health insurance must be minimum essential coverage. That has an exact meaning. What is minimum essential coverage? The exact meaning is that it does not have an exact definition. Don't you love our government? That's their definition, is it does not have a definition. Instead, the government made a list of approved insurance that meets this standard. Most health insurance offered to you is going to qualify, but there are some ones that won't qualify. So I know that's confusing, but that's our government at its best. Minimum essential coverage means you got to have this. They did not give us an actual definition. They have defined it by giving a list of approved sources and basically saying these are approved sources and ones like it. Okay. I'm not going to put up and ask you to memorize a list of approved resources. What I do want you to know is almost every insurance offered to you through your work, most of it is going to qualify for minimum essential coverage. The best way to define it then is to determine what it does not cover. So minimum essential coverage does not include coverage that provides only limited benefits. So if it's only giving limited benefits, it's not going to be minimum essential coverage. For example, covers only emergency medical situations. This is the biggest one you'll run into in real life. Somebody might have what they call catastrophic insurance. If they say, well, I've got catastrophic insurance or hospital insurance, they probably have only emergency medical situation insurance. That does not count. Dental only does not count. So what does that tell you about minimum essential coverage? Just kind of read between the lines and tell me what you think that tells you about minimum essential coverage.
Medical insurance for the whole year.
Well, you got to have it for the whole year, but what does it tell you about the minimum essential coverage? You got to have it for the whole year, but you could have dental insurance only for the whole year.
Hospitalization.
So it's got to cover like most stuff.
Yeah, hospitalization and consultants.
Yes, that's right. And consultations. Yeah.
Consultation.
That's right. You got to be looking for something where somebody can get some coverage for, if they haven't the proper insurance, they've got some coverage for seeing a doctor, for seeing a specialist, for having tests done to help with medicine. Now, it does not require exact things like how much your deductible is or anything like that. So you could end up with a very high deductible in your insurance and still meet the minimum essential coverage requirement. But notice, if it's only limited benefits, if it's limited, it's probably not gonna qualify. So here's the point. Minimum essential coverage has to be something more than limited benefits. If it's more than limited benefits and it looks like it covers some other stuff, it's probably going to take care of it. So your health insurance must be minimum essential coverage. Now, you can get minimum essential coverage health insurance from these sources. You can get it, first of all, from your employer. And when I say employer, I'm talking about whether it's a government employer, in other words, state of Oregon or the U.S. government, or a non-government employer, a private company. It doesn't matter. When I'm saying employer, it doesn't matter. I'm not saying whether it's government or not government. I'm not even saying it has to be the U.S. government. It could be a foreign government. Maybe you're working for a foreign government here in the U.S., which is very possible. Some people get jobs with foreign governments here in the U.S. If that government provides health insurance that meets the minimum essential coverage requirement, then you're still covered. Now, minimum essential coverage can also be from a government paid program. These are ones that are provided to you for free. For example, Medicaid or Medicare or CHIP. CHIP is the basically, it's similar to Medicaid for children. Okay. So government paid programs are ones that are provided for free. Or it can be purchased through your, you can purchase your own insurance through the marketplace. Now here's the trick. You can always purchase your own insurance, but it's not, okay, you can always purchase your own insurance, and if you purchase it through the marketplace, it makes it marketplace insurance. The difference is I can choose to go and buy my health insurance directly from, you know, a company, Cigna or something like that. I can choose to go pay for it out of my own pocket and never go through the marketplace, but I can go through the marketplace. But I can also choose not to. In either case, as long as I got insurance, I'm meeting the minimum essential coverage sources. But if I go through the marketplace, there's some benefits. What are those? The benefit of using the marketplace is that, first of all insurance offers meets minimum essential coverage requirement. What do I mean by that? If you go to the marketplace and search for health insurance, there is none there that does not meet the minimum essential coverage. Everything in the marketplace that's on that list of coverage that's available, all of it's going to meet the minimum essential requirement. And that's a benefit. So if you go to the marketplace to look for your private insurance, you know it's all minimum essential coverage and meets that requirement. And only if you're in the marketplace, you might qualify for the government to pay some or all of your monthly premiums, the premium tax credit that we'll discuss later. We've touched on it already, but we're going to get into that later. These are just general rules having to do with the Affordable Care Act. So 3 places to get minimum essential coverage: employer, government paid programs such as Medicaid or Medicare, or you purchase your own insurance. And if you do it through the marketplace, you know for sure that it's minimum essential coverage. Or, like I already said, you can purchase your own insurance directly from an insurance company. This is where you purchase it, but you do not go through the marketplace. If you use this option, make sure it meets the minimum essential coverage requirement, because this is where you can start running into, you know, that cute little advertisement I like so much, Aflac. I like who likes their little duck.
Yeah, he's funny.
I love their little duck, Aflac. I love it. But guess what? Aflac is not generally, to my knowledge, none of it is minimum essential coverage.
It's not.
I didn't think they offered any. Now, I've had Aflac offered to me in some jobs, and what it does is it supplements some costs that I put out. If I do certain things based on my age or something like that that I should do to take care of myself, and I do it, they encourage that by paying out a certain amount of money to offset the cost. So anyway, my point is if you're going to buy insurance directly from an insurance company and not go through the marketplace, make sure it at least has a minimum essential coverage requirement. And if you use this option, you must make all of the payments yourself. Even if you would have qualified within the marketplace for the government to pay some of it, you're not going to get it because you have to, first of all, apply through the marketplace. When I say apply through the marketplace, let me clarify what that means too. That means you go to an actual online site, you put in your personal information that identifies you, and then you answer a bunch of questions that has to do with you and your age and where you live and all that, because that all affects what's available to you in the market. And then when you get done with all of it, the government has that information, they save it, and then they say, okay, here's what's available to you that meets minimum essential coverage. And here's the amount that we will pay each month based on the information you gave us. So that's the benefit of going through the marketplace, but you don't have to. You can get it yourself, but you're not going to get any premium payments to help you out.
James,
Yeah,
does VA count as a government plan?
it sure does. That's part of government paid programs. I could have put VA in there. You bet. That
Okay,
would have
thanks.
fit right there. Yep. Okay. Actually, before we go on to page 2, any requirements about the basic requirements for the ACA? I mean, these are pretty straightforward, but this is the stuff you have to know to pass exams right here. Pretty good? Feeling confident about this so far?
I used to sell Aflac, so yes.
Yes, sir. I sell insurance.
Okay. Okay, good, good. All right. So we'll move on to page 2 then. Now, the provider of the insurance must report to the IRS and to you using one of these forms, and that form must be sent to you by January 31st. What other form has to be sent to you by January 31st?
The W-2,
Yeah, W-2.
W-2 is one of them. What else has to be sent?
1099.
1099s, most of them. Yeah, you're right. So these are called 1095As, 1095A, 1095B, or 1095C. Each of them have a different purpose, and these are really important. 1095A is used when you get insurance through the marketplace. If you get this form, you had qualifying insurance for some or all of the year. If you get this form, this is a critical form. It must be accounted for on your tax return. Absolutely must be accounted for in your tax return. If a client comes in with one of these, you cannot ignore it. You cannot ignore it. You've got to deal with it because it's telling you information about the client in front of you. They had health insurance. For how many months did they have qualifying health insurance, and how much did the government pay of that? It's going to tell you all of that because you've got to figure all of that to see if that person underpaid or overpaid, which we'll talk about later. But that's all wrapped in with the 1095A. So what's a Form 1095B? This form is one sent to you by insurance companies, so health insurance companies. If you get this form, you had qualifying coverage for some or all of the year, just like up above. But this has nothing to do with whether or not you were in the marketplace. This is coming to you because you had insurance through, you got insurance either privately or through your work, and it was covered by an insurance company, and they're required to send that to you. And why do you think they would be required to send this to you? So you could prove you had minimum essential coverage. That's exactly why they're required to send this to you. Garrett, you asked, they need to have these documents in order for us to file their return, correct? Amanda wrote, it's not something you have to include in the return, but due diligence, ask them. Okay, look, guys, I kind of want to let me talk about each of the forms, and then I think your questions are spot on. But let me see if we can come back to that discussion after I cover the material, because I think we'll clarify it, okay? And if I don't, Amanda and Garrett, remind me, okay? Okay, so 1095B is from an insurance company. It's required to be sent to you and to the IRS. It's required to be sent so that you can prove that you were covered. 1095C, this form is used by something called applicable large employers. ALEs for short. And what's an applicable large employer? An employer that has 50 or more employees. And what we mean by that are either 50 or more employees that are full-time equivalent. So full-time equivalent means you can add 2 part-time employees up, and they might together only add to 1 full-time equivalent employee. Okay, so just to let you know. So this form is used by applicable large employers. If you get this form, you might or might not have had coverage. This is important that you hear that. You might or might not have had coverage. Just because you get this doesn't mean you were covered by health insurance, by minimum coverage that's required. Parts 1 and 2 tell you what type of coverage was offered by the employer. Notice the key word here is offered by the employer. And then part 2 is whether or not you accepted it. So you got to pay attention. If you get a 1095C and somebody shows that to you, it is important that you take a look at it, because you got to see what was offered to by the employer, and then was it accepted or not. Okay? So part 1 tells you what did the employer offer to them. Did they offer them a minimum essential coverage? And you'll tell from the codes that are on there. Part 2 will tell you whether or not the employer accepted it. Specifically, it'll tell you what the employer did accept. If they accepted only dental insurance, is that going to be minimum essential coverage?
No.
No, it's not. Okay. And then part 3 will be blank if the employer was using an insurance company. But part 3 will be filled out if your employer was self-insured and you participated in the plan. So what do you think self-insured means? The employer was self-insured. What do you think that means?
They had their own insurance plan.
Being provided, they're paying for it.
Employer provided the insurance. That's right. You guys all got it right. The employer isn't just, I just want to clarify, the employer in this case is not just paying for the insurance. They are providing the insurance. They are their own insurance company effectively. They feel they have enough employees and they can do a better deal just by providing their own insurance plan, so they do it themselves. They become self-insured.
Are they like purchasing a plan and they're just paying the fees for you?
No.
Or is it okay if they just pay out of pocket whatever you inquire?
That's medically? Sort of what it is. They're setting themselves up as if they are their own insurance company.
Wow, okay.
Look, if they do this kind, if they do the type you were asking about, Amanda, where they're just paying it for you, they're using an insurance company. In which case, you'd get a 1095C from them with parts 1 and 2 filled out, nothing in part 3, and you'd be getting a 1095B from the insurance company.
Okay.
Does that make sense?
Yeah.
Now, if it's an ALE that has parts 1, 2, and 3 in there, are you going to get a 1095B from an insurance company for that company?
No.
No, you're not, because they're self-insured. And it's also it also can be blank if you chose not to participate in the plan. But you'll know that from part 2 anyway, because you'll see that what they did or did not participate in. So this is really important. 1095B and C do not have to be directly reported on the tax return. In fact, we encourage you not to actually take the time or potentially drive up the cost on a client to actually plug those into the return. You need to get the information off the return. Was this person covered? If so, did they have minimum essential coverage? If so, how many months were they covered? As long as you got that, you're good to go. 1095A is different because the government paid part of the insurance, and you've got to calculate that out on the tax return and report that as part of your tax return. So this is one that does have to be plugged in, and you have to account for that. Okay. Okay, so are these 3 forms pretty clear in your head what's involved with them?
Yeah.
Okay. Now's the chance to ask questions. Okay.
Okay, I have a question.
All right, go for it.
Because you said a while ago, Form 1095C,
Mm-hmm.
Part 1, the employer offered health insurance. It means you have an option not to accept it and go to the marketplace.
No, not to the marketplace. It means you have an option to accept the employer provided health insurance. You have the option to accept it.
Yeah, if you
It
do
has
not
nothing
accept,
to do with it has nothing to do with the marketplace.
yeah, so I have an option to buy my own health insurance even if I am employed.
Oh, of course you do, but you will not qualify. You will not qualify in the marketplace if you do that. If you have
Okay.
qualifying insurance through an employer, if your 1095C shows that Part 1 shows that you had the option to purchase or to get health insurance for yourself through your employer and you chose not to, but you went or you tried to go to the marketplace and purchase your own, you're going to get kicked out of the marketplace because you qualified down here.
So then you just don't have insurance if you don't take it?
You still got to have insurance, yeah.
But where do you go? If you choose not to take the insurance that's offered to you, where do you go from there?
Well, you can still go buy it. You're just not going to get in the marketplace. You can still get qualifying insurance using this. Purchase it directly from on your own, but you're not going to get any help making monthly payments. See, the thing is when you're offered health insurance, you're pretty much from an employer. You're pretty much probably stuck taking it unless you have options somewhere else. To get in the marketplace, you cannot have health insurance available through your work or through your spouse's work or something like that. Okay.
Okay.
And because if you do, you don't qualify for the marketplace. What's the benefit of the marketplace? Not only will it help you make sure you're getting an insurance meets the minimum requirements, but the real big benefit most people go into is to get the government to pay part of the premiums. If you got an employer offering you health insurance, they're not going to pay part of the premiums for you, so they're not going to let you in the marketplace.
But you mentioned again about the spouse. If the husband is offered health insurance from employer, the spouse can go to the marketplace?
Oh, it's possible. It depends on what's offered. If the company, let's say husband and wife, let's say husband's working for a company that only offers the husband health insurance but not the spouse, then yes, the spouse can go to the marketplace. But if it's offered to both of them, the spouse cannot go to the marketplace. It has to do with what's being offered. That's why this Part 1 is so important on here. It tells you a lot of information, what's being offered, who's it being offered to. See?
Okay.
Yeah, and don't let this get you all confused. It's pretty straightforward. C is for large employers, 50 or more employers, Part 1 tells you what are they going to offer to you. 2 is going to tell you what did you actually accept, and 3 is going to be filled out if the employer is self-insured. And then if they're not self-insured, that means you're also going to get a 1095-B from the insurance company that the employer is working with to provide insurance. Okay, Garrett, that's awfully long. Could you jump in and just ask your question?
So essentially what I said was if they did purchase through the marketplace with a 1095A, we need to have that in order to file their return for them to go with the return.
Yes.
The 1095
Absolutely.
or C, we don't need to have. We just need to include the information of that in the notes, and that they're responsible for having that if the government
Yes.
asks for that. Correct?
That's correct. That's 100% correct.
That's
Everything
what
you
I
said.
just want to make sure that was.
Yeah, that's why I don't want to get into all these tweaks, and to make it even worse is we don't know what's going to happen with it in the future. Now, for 2018 still, if you did not have qualifying health insurance coverage during the year, you will be subject to an individual responsibility payment. That is, you're going to pay a penalty, okay? Now, that's what the question was that I think it was Sheila that was asking about earlier, is in 2018, that was still in effect for 2018, okay? Actually, again, the law is still in effect. The President Trump, though, did sign an executive order well more than a year ago, a year and a half, 2 years ago, something like that, saying not to enforce this individual responsibility payment. But you're being tested on 2018 law. This is being enforced. And by the way, it's still the law on the books. It's just he's using an executive order to override the law. Okay.
Right.
Okay, so, but it is important that you know this. So if you don't have qualifying health insurance coverage during the year, you will be subject to individual responsibility payment, okay? In other words, you're going to pay a penalty. Now, you know this, everybody knows about this for several years. This went through the court system. It went all the way to the U.S. Supreme Court. This is considered a tax, and that's how it was considered legal, is this penalty was considered a tax. And therefore, they said the Congress can add tax. So just letting you know a little bit of the history so this makes sense. So if you don't have health coverage during the year, you're going to be subject to a penalty. You calculate the penalty on this form, the 8965. That's how you calculate the penalty. I'm going to kind of cover a little bit about what's involved with the calculation, just so you got a general idea, but I'm not 100% concerned that you memorize all of it. If you did not have coverage at all during the year, the penalty amount covers the entire year, okay? So if you did not have coverage at all during the year, the penalty amount covers the entire year, okay? Which means the penalty amount you end up with is for all 12 months. That's assuming you had zero coverage all year long. However, if you did not have coverage for part of the year, what do I mean by that? Well, maybe you have coverage for like 5 months and then you lost your job, and so you lost the health insurance and you didn't have any for the rest of the year. So you're covered for 5 months and not covered for 7 months. That's what we're talking about. So if you did not have coverage for part of the year's penalty amount is divided by 12 months and then multiplied by the number of months without insurance. All we're doing, in other words, we're prorating this. We're figuring out how much. We're taking the full annual amount and dividing it by 12 and then multiplying it by the number of months that you did not have insurance. Okay. So here's it. To me anyway, this might or might help, but to me it's easier to see a formula. Total penalty equals the penalty for the whole year divided by 12 times the number of months without insurance. Okay, so let's do one just for fun together, okay? Let's say the penalty amount, and I'm making these numbers up, but let's say our total penalty for the year is $500 and number of months without insurance is 7 months. What's our total penalty?
$291.67.
$291.67. Everyone get the same answer?
Yes.
Got it. Yeah.
Yeah. Yeah, that's all it is. That's all they're doing. That's all they're really doing on the Form 8965. They're just, it's a little bit more involved, and it's safer in real life for you to use the form because there's some questions and stuff you want to be careful of. But this is basically what it's doing. It's just you're looking up the penalty amount for you know, everyone in your household, you're in the circumstances and how many months you weren't covered. You're having to figure all this out per person, then you're adding it all together. Okay, so you report the shared responsibility payment, which is an additional tax on Schedule 4, line 61. So let's everybody grab your 1040, Schedule 4. Let's all go there and take a look. Is, everyone see that?
Yes.
Healthcare, line 61, healthcare, individual responsibility, see instructions. They're just saying see instructions because you got to do that form. And that's the amount of the responsibility. So in this example we did, which Garrett rounded to $292, he's right, 291.67 would round to 292. So you'd report $292 on line 61, and that would be an additional tax that would be added on to the taxes that you owe. Okay. Before I get into that, any questions about what's going on here? Okay. Now, if you are subject to the individual responsibility payment, it's possible you might qualify for an exemption. You use that same form, the 8965, to claim an exemption. Now, there are 3 types or categories of exemptions, and each of them have several possible exemptions. I'm going to kind of give you the overview, and then we're going to talk about them. There are exemptions from the marketplace. There are exemptions from the IRS, and then there are exemptions from either the marketplace or the IRS. Exemptions from the marketplace. These are ones where you must apply to the marketplace for any of these exemptions. You actually have to apply to them, say, I want to be exempted. You fill out their paperwork, provide whatever documentation or proof they may ask you for, and then they have to grant it in writing. You have to do all of that before you file your tax return if you're going to use an exemption from the marketplace, because you actually have to report that along with your return. Okay, so exemptions from the marketplace, you can get them, but you got to plan ahead if you're going to use those. What about exemptions from the IRS? These are ones that you can apply for these exemptions when you file your tax return. These are ones that you got to make sure you meet the requirements. Again, there's several different ones. There are ones that you got to make sure you meet the requirements. Don't just assume that from the title. Let me give you a good one. Considered unaffordable. That's one many people use, and it's wrong when they use it many times. Considered unaffordable doesn't just mean, hey, I feel like it's too expensive, which is what most people define that as. I feel like I can't afford other stuff if I do that. The IRS has very specific formula that has to be applied to determine if it's really considered unaffordable. So for a client, if you're ever doing a 2018, 2017 or earlier return, make sure before you put down an IRS exemption that you are meeting the requirements exactly by definition. I'm not going to ask you to memorize those. I don't think it's worth the time. We don't know how long this will be around. It might stay around. It might not. We don't know. But what I do believe is you're not going to get tested on anything that exact. They're going to test you on, do you know about the exemption? And if they qualify, they'll probably say, you know, Susie qualifies for this exemption for X number of months. You know, they're going to ask you some question and give you general information. They're probably not going to ask you to go through every test of the exemption. So, exemption from the IRS. You can apply for these exemptions when you file your return. So what are the difference? Exemptions from the marketplace. You have to go to the marketplace and get permission before you file the return. Exemption from the IRS. You can do it when you file the return as part of your return on Form 8965. Okay. What about 3? Exemptions from either marketplace or IRS. This is where you just follow the rules above to obtain the exemption. What this really means is there are some that overlap. Some of the exemptions you can go to either the marketplace or the IRS to get. As a practical matter, it's much easier to go through the IRS when you file the return than it is through the marketplace. But these are ones that you can go to either place. If you go to the marketplace, you still have to get the exemption before you file the return. If you go to the IRS, you have to do it when you file the return. It's that simple. And incidentally, there are some that are done by the marketplace that the IRS will not do, and vice versa. There are some the IRS permit that the marketplace will not permit. Okay? Now, if you and everyone on your return had qualifying health care coverage in the year, mark the box. We're going to come to that in a second. You and everyone on your return. This is kind of a tricky statement there. There are specific definitions for what is covered in your tax return. And there's different definitions for those that are covered for the Affordable Care Act. They're mostly the same, but there are some overlaps. For example, remember in some cases, Johnny might live with you all year, but Johnny is going to be claimed on somebody else's return for 2018. Was Johnny part of your household for ACA, or was he part of his dad's household for ACA? Which do you think?
His dad's dependent, correct?
I'm sorry, say that again?
He was his dad's dependent?
Yeah, he lived with you all year, but dad's claiming him under the rules for divorced and separated parents. In that situation, whose responsibility is it to make sure he has individual responsibility, and who will pay the fee if he doesn't? Mom or dad?
Dad.
We haven't covered this, and I know that. I'm just introducing it now.
It's the parent that doesn't have the custody of the child.
It's
what I've known. Because they're responsible for the health care.
It's the parent. It's normally the parent that does have responsibility, unless there's some other reason that makes the other parent responsible. Is that what you were saying?
Yeah.
Yeah. So in that case, it would have been mom.
Yeah.
So the fact that, see, there are situations where you might have somebody in your family that is not on your return for whom you're still responsible for this to make sure they have it. Okay? That's just important to know that. Is that totally confuse everyone?
So it's because he lived with you, not because you claimed him as your dependent.
That's right. That's right. Yeah. It has to do with who's responsible for it. It has to do with the definition. What does it take? Notice I'm not getting into the heavy definitions here because I don't think you're going to be tested on it. If you are, it'd be one question, and even that I doubt. But I want you to know, just in case the one question came up, just know that you can have everybody that lives in your household has to, you've got to make sure if you and dad and Johnny all live together in one household, you and dad are both responsible for health insurance for you, dad, and Johnny. All of you have to have it. If any one of you or all of you don't have it, you're going to start paying some penalty. We know that. But what if you and dad are separated, living apart, divorced? Who's responsible when Johnny is normally on your return every odd numbered year he's on your return, but dad gets to take him every even numbered year. So dad's taking him in 2018. Who's responsible to make sure he has that health insurance? You are, because by definition that they use, you're the responsible parent. He's in your family. Yeah.
He's in your household.
Yeah. So just try to keep that straight. Hopefully I've kept it straight. It's always been confusing to me because it's similar, but a little different than the normal tax law.
Right.
Okay. Now,
whoever will claim the child as dependent is responsible for the health coverage.
Not necessarily. Not necessarily. That's not it. No, not necessarily. You're asking, will it follow the child? Not necessarily. It's who. It's not. It might, but it depends. That's why I know I'm being a little vague, and I don't mean to be, but it depends on who is responsible. It's the definition for who is your family member for the purpose of the health care. Don't think taxes at this moment. For health care, what is the definition? It's the person who lives in your household and that you claim on your return or would likely claim on your return, except you gave the exemption away to someone else.
Okay.
Okay. So I don't want to get too deep into it. Just try to keep that straight. We'll do some practice questions with that in it, I believe. Okay. Now, if you and everyone on your return had qualifying health insurance for all year, you mark Form 1040, page 1 in the label section. So everybody look at Form 1040, page 1. So everyone see on the far right side underneath your Social Security number, then spouse's Social Security number, there's a box there.
Yes.
It says full year,
Full year.
yep, health care coverage or exempt. So you'd mark that if everyone, you and everyone on your return had health coverage all year long. Okay. Now, except for the definition of you and everyone on your return, that can be a little confusing. Does everyone else, or does everything else appear to come across pretty straightforward? Okay. All right. Ready to go on to page 4?
Sure.
Yes.
Okay, so what we've talked about is what is the ACA generally, then specifically what happens when you don't have health insurance for all or part of the year. You have to calculate how much your penalty will be. And then, of course, you had it for part of the year. You divide by 12 to figure out how much it is for each month. And then each month that you don't have it, you don't have health insurance, you have to pay a penalty. And there was something else I was going to say, but it'll come back to me. So let's talk about the premium tax credit. This is the other half of it. This is the part that people who need help really like. Premium tax credit. What is this credit? First of all, it is a part of the Affordable Care Act. What does it do? It helps you pay for health insurance. You pay part and the government pays part of it. Okay? You pay part and the government pays part of it. And it is a refundable credit. And where do you take this credit? It tells us right there. Everybody see where you take the credit?
Yeah.
Schedule 5, line 70. So I want everybody to go to Schedule 5, line 70. What does it say there?
Net premium tax credit attached Form 8962.
Perfect, perfect. So you'd calculate it on the Form 8962. So what is this? It's part of the Affordable Care Act. It helps you pay for the health insurance because it basically is saying the government's going to make part of the monthly premium insurance payments for you, and it is refundable. So if you paid too little, you're going to end up with a refund. In other words, you can end up with a refund because of this if you actually paid more than you were supposed to, because realize these are estimates. So for an example, you qualify for this credit. Let's just say you otherwise qualify for the credit. You paid $6,000 in health insurance premiums out of your own pocket in 2018. The government calculates that it should pay $4,000 of that for 2018. When you prepared your tax return, you got a refundable credit of $4,000, the amount the government should have paid, because they didn't pay any of it. You paid all $6,000. Now, in real life, the government might pay part of that as you go through. Advance premium tax credit, that's right. So the government might have paid part of this already, and so you didn't really pay this full amount. But you see what I'm saying? This is assuming you paid it all out of your own pocket because you didn't know how much and you didn't want to owe at the end of the year. They should have paid $4,000, so you get a $4,000 refund. So, let's go ahead and go on. We'll come back to this, okay? Requirements. No one can claim you as a dependent on their return. Okay? Because if you're a dependent on somebody else's return, there's a good chance that you are going to be, that somebody else is going to be responsible to make sure you have health insurance. Okay? So you cannot be dependent on somebody else's return and claim this credit. No MFS. Well, there we go again. Even if you could have gotten a refund from this, MFS is going to kick you out. There are exceptions for certain domestic abuse or spousal abandonment situations. Just know these two exceptions. Don't know all the details about it. Just know there are exceptions. You could possibly do an MFS and still get the credit if you were in a domestic abuse situation or spousal abandonment where your spouse left you unexpectedly. So that's the one. Those are really the only one exception to MFS. No MFS. Now, coverage not available through an employer or a government plan. Okay. Now, remember we were talking earlier where I was saying, look, if you have coverage available through your employer or somewhere else, you don't qualify for this assistance. This is what I was talking about. Okay. So when you've got if you've got coverage available through your employer and you choose not to take it, can you go into the marketplace and get the premium tax credit?
No.
No, you can't. If it's available through a government plan, can you use the premium tax credit instead?
No.
No. Okay. One or more persons you can claim on your tax return are also covered by insurance through the marketplace. This is sort of self-evident. What it's saying is somebody has to actually be covered through the marketplace, at least one person on your return, either yourself or someone else or both of you. So you have to be in the marketplace. So, and then your household income has to be between certain limits. I'm going to talk about that in a minute. Want to kind of cover the more general requirements. You cannot be dependent on someone else's return. No MFS except for what two situations? Except for what two situations?
Domestic abuse.
Or abandonment.
Or
Or spousal abandonment. That's right. Coverage not available through an employer or government plan. And one or more persons on your return must be covered by insurance through the marketplace. Okay. Obviously, if nobody's covered through the marketplace, but you just bought the insurance directly from an insurance company, can you get this credit?
One more time?
Yep. If you purchased your health insurance directly from a health insurance company and not through the marketplace, can you get this credit?
No, because the government didn't help pay for any of it.
That's right. That's what this is saying. You or someone on your return that you're claiming must be in the marketplace. They could not have gone and bought it from a private insurance company. And obviously, they could not be getting their insurance through an employer or government plan. And they could not have qualified for insurance through an employer or government plan. This, as you can see, is very restricted. It's meant to be restricted. It was intended to help people that cannot afford health insurance and didn't have it available through work. That's exactly what this was created to do. Okay? So any questions about those or discussion you want to have on those particular requirements? I don't want to cut you off or rush you through this. Okay. If you do, you can always back up. Now, there's another requirement. It has to do with the federal poverty level. FPL is short for federal poverty level. Now, what does that mean? That's an amount that the government has determined that if you're making less than that dollar amount, you're considered by definition of the government to be in federal poverty. That level is sort of the point where you move from being in poverty to out of poverty. Okay? So there's a rule that has to do with, is your household income between the federal poverty level and 4 times the federal poverty level. Okay, so we could have also put in here 1 times the federal poverty level and 4 times the federal poverty level, but I just, to make it fit and easier to read, I just said between the federal poverty level and 4 times the federal poverty level. Now, use this as a visual down here. Assume that this is FPL is your federal poverty line. That's the amount they established, the government has established as federal poverty. So that's the line there. Now, if I take this amount and multiply it by 4 times that, that's this line here, okay? So anything below this line, below the federal poverty line, the government will pay the insurance through Medicare, Medicaid, whatever you qualify for. The government's going to pay it. Remember, that's one of the ways you can get health insurance is you can get it for free from the government. You can if you're below federal poverty level. If you're below that line, the government's going to pay for your insurance. Now, what if you're at above 4 times the federal poverty level? So 4 times the federal poverty level, you have to pay for health insurance yourself. You pay for it yourself. Okay? It's the people that are in between federal poverty level and 4 times federal poverty level. These are the ones that qualify for the marketplace premium tax credit. You pay part and the government pays part of your insurance. They're the ones that qualify. Now, have I asked you to memorize the federal poverty level?
No.
It's silly to. Chances are they're going if they want you to, if they need you to know federal poverty level, they're going to give you a little chart that says federal poverty level. The chart, if you wanted to, you could look it up. I wouldn't take my time to, but you can look and you can see for what area you live in, what's the federal poverty level for your state. You can look it up. That's what you do. And if they have a question where they want you to know federal poverty level, they're either going to give it to you or they're going to give you the chart. Okay? And then once you know that, you know it has to be between federal poverty level and 4 times federal poverty level to even have a chance, your household income, to even have a chance to be considered for the this credit. Okay? So does that make sense, this household income
Yes.
requirement?
Yes.
Okay. So the requirements are not difficult. You can't be dependent, no MFS except for the exception, no coverage through any other plan available, and at least 1 person on your return has to be in the marketplace, and your household income has to be between federal poverty level and 4 times federal poverty level. You should memorize those. You might get a question or 2 on that. You might. Okay?
Okay.
So how do you claim this credit? Well, you have 2 options. First of all, you can claim the credit on your tax return. Okay? So you calculate the amount of credit on the form 8962. Notice anything related to Obamacare or the Affordable Care Act is all done on form 8962. So you calculate the amount of credit on the form and then you carry it to Schedule 5, line 70. We've already looked at that. We see where you'd carry that to Schedule 5, line 70. We looked at that earlier. Okay? To do it this way, you must have paid 100% of each month's health insurance premiums during the year. In other words, you did not have the government pay any of it during the year. You know you've got a credit coming. You want to take it all as a credit at the end of the year. And then you take that's what this is saying, you take the credit all at once when you file the return. So that's how you can get this credit. That's one way. That is certainly a way to do it. And the people that do it are ones that usually can squeak by because they feel more confident that if they do it this way, they won't have it. What if they're worried usually about overpaying or underpaying? What if at the end of the year, it's determined their income was off a little bit from what they estimated? Suddenly they have to pay some of this. If some of it was paid by the government for them, what if the government paid too much of it? Well, now you have to pay it back as a form of a tax on your tax return. So it's safer to do it this way if you can afford it. because then there's no danger in you having to pay anything back. But it does mean you have to pay it all out of your own pocket. So this is an option. There is another option, and this is the one most people use. You can claim part of the tax credit in advance by letting the government pay part of each month's premium and you pay the rest of each month's premium. This is called advance premium tax credit because you get part of your credit in advance of filing your return. Each month, you're taking a piece of the credit. So if the government was the estimated when you first set up through the marketplace, let's say the government estimated it should pay $4,000, and it has paid, and it has been paying each month a certain amount. Give me just a second. I'm doing a little bit of math so I can give you some good numbers. Let's say each month it has paid $300. So how much has it paid all year long for you?
$3,600.
$3,600. And if its estimate is correct that it should have paid $4,000, how much are you going to have as a refund coming?
$400.
That's right, the other $400. But what if the estimate was off because the income was off? Let's say you actually, it estimates at the end of it that it should only pay $3,000, but it actually paid $3,600. You're going to have to pay back that $600. See? Okay. So
if you do get a refund from it, you don't have to use it for medical.
No, you don't. No, this is purely a refund at that point. So this is called advance premium tax credit because you get to take part of it in advance. When you file your return, you must determine or reconcile, is what they call it, if the government paid too much or too little of your premiums. And that's what we were just talking about. So if the government paid too little, that means you have additional tax credit that you're going to get a refund for. And that's what we just said in our first example. They said that they should pay $4,000, and that's what they should have paid. They actually only paid $3,600. So you have a refund or an amount owed of $400. The government says that it should have paid $4,000, but it only paid $3,600. Do you have a refund of $400 or an amount owed of $400?
Refund.
Refund
of $400, and where is that going to go? Tells you right on the screen.
Schedule 5, line 70.
Schedule 5, line 70. And if we looked at that under the refund,
Yes.
Yeah, we have. That's where it would go. Now, what if the government paid too much? Go into that example where the government says they should have paid $3,000, but they actually paid $3,600. You have to pay some back, don't you?
Right.
You owe $3,600. Where is that going to be reported?
Schedule 2, line 46.
And everybody, let's go to Schedule 2 because we have not looked at that. Schedule 2 are additional taxes. Now, we did briefly, when we were looking through these forms, we did briefly, I think, go over these. These are just additional taxes that get added into your other taxes. Notice line 45 is alternative minimum tax. We're not going to cover this. I don't think you're going to need to know it. There's 46 is excess advance premium tax credit repayment. So in our example here, how much would you be putting on line 46?
This is the $400 one, right?
This is the one that the government said they should have paid $3,000, but they actually paid $3,600.
Yeah, 400.
How much are you going to?
400.
The government paid $3,600, but should have only paid $3,000.
600.
$100 difference.
600. Yeah, there we go. It's important. It's important to keep that straight. Okay. Now let's use an example. Okay. You signed up for health insurance through the marketplace. At that time, the marketplace estimated, based on the information you provided, that you could receive assistance of $200 a month. So for a total credit at the end of the year of $2,400. That's $200 times 12. That gives us $2,400. So far, so good, everyone?
Yes.
That's what they're saying that they that you're that they would pay. Right. So your health insurance premiums are actually $500 a month. That means there's total premiums at the end of the year of $6,000. That's $500 a month times 12 gives us $6,000. This means that you paid $300 per month out of your own pocket. You pay. There's supposed to be $500 for the premium minus the $200 the government paid every month. So you were paying $300 per month. When you reconcile on your tax return, it's found that the government should have actually paid a total of $3,000 for the year. However, it actually paid only $2,400. Therefore, you have an additional premium tax credit refund of $600. The $3,000 that it should have paid, it discovered it should have paid when you did the reconciliation, minus the $2,400 estimate that it actually did pay, leaves you with a $600 refund. Does that make sense what we're doing here?
Yes.
Yes.
Yeah. So note, I want you to know this, the actual reconciliation is a little more involved. This is an example just to give you an idea how this credit works. These numbers would not actually work if you were to go and use the form. They would not work perfectly. So I want you to know that if you were to go use the form, it's not going to work perfectly. This is so you can understand the basics of what's going on, okay? Because there are some numbers and percentages and things that are applied to it. Okay?
Yes.
All right, so that's how you report it. So you report if you can potentially, if you're taking advanced premium tax credit, you could potentially end up paying too much or too little. If you pay too little, you've got a refund or an amount due.
Amount due.
If you pay too little?
Yeah.
No, if you pay too little, wait a minute, let me see what I'm saying. Make sure I'm not.
Yeah.
I've done this before. I've done this before to you guys. I'm doing mental gymnastics in my head when I'm teaching.
You said I'm paying too little.
Let me rephrase what I'm saying because I think this is coming. It could come out either way. Is the problem the way I'm wording it?
Dapat,
When you're paying amount in, okay, and the government has paid too much more than they should have, are you going to have an amount due or a refund?
Amount due.
That's right, because the government paid too much.
Too much.
If you paid too much, are you going to have a refund or an amount due?
Refund.
That's right. There. See, that was cleaner. You guys, I saw the way I worded that, and I realized that was going to be confusing after you did that. Okay. So how do you calculate the premium tax credit? You must have the Form 1095A in your possession to calculate this. This is why this is critical when doing a return. Remember, 1095B and C is information only to determine if a person had coverage and how many months they had coverage and was it minimum essential coverage. That's what those are for. This is to actually calculate whether or not there's a credit or an amount owed because of the advanced premium tax credit. You must have this form in your possession. You cannot do it without it. Then you calculate the credit in real life. I want you to calculate the credit on Form 8962. And then you carry the credit amount to either Schedule 2, line 46, if there's an amount owed from it, an amount to be repaid, or Schedule 5, line 70, if there's a credit. In other words, you overpaid and you're getting some money back. All right. So now is the chance for you guys to ask some questions, and then we'll go into some like knowledge checks. But now I've finished the presentation having to do with this. 6 pages worth of kind of detailed information, but this is the information you need mostly to pass an exam on this, on the Affordable Care Act. So questions, comments? I want to give you a chance to interact with it.
Okay, I've got one.
Okay, Sheila.
If you have somebody who's got joint custody of kids, So there's mom and dad. Mom has insurance on both of the kids. Dad doesn't. If dad doesn't have insurance on himself, but obviously the one child is covered, then he would pay, he would have to pay the penalty on himself, right?
That's correct. Not on the child. You're correct.
Okay.
That reminds me, thank you for the question. That reminds me, Sheila, the one piece I forgot to mention. Remember we said that you could be covered for part of the year and not the other part of the year, and then you
Right.
divide it up.
Mhm.
Any month in which you're covered for part of the month with health insurance, you're considered covered the whole month. So if you got dropped off, let's say you had health insurance from January 1st all the way through October 2nd,
Mhm.
you're considered covered all the way from January through October. You get to, all it takes is one day of the month of coverage to count for the whole month. That's what I forgot to mention.
Okay.
So in that example I just gave you, you would only be considered not covered for 2 months of the year.
November and December.
And you're allowed
November,
to be,
December.
that's an exemption, right? You're allowed 3 months of non-continuous coverage.
Less than
Less than 3
That's
months.
3 months
Yes.
of continuous.
Yes, but realize it has to actually be less than, not just in the year. It rolls over. 2018, let's say it was 2018, you weren't covered for November and December 2018, but you got health insurance in January of 2019, you're good to go. But if you didn't get health insurance until March of 2019, you went more than 3 months without coverage, in which case you cannot take the exemption.
Because it's in any 12 months, not
It's 3
tax year.
consecutive months. That's right. It's 3 consecutive months. It's not just, it doesn't just end on December 31st for that. That's just one of the exemptions. We never really got into what the exemptions were, but yes, 90 days is, or 3 months is one of the exemptions. Just remember, it is an actual 90 days. If you have not gotten health insurance within 90 days, even if it's in a new year, then you're not going to qualify. Good question.
What about the net investment tax or the additional Medicare tax?
What about them? I'm not sure what you're asking me.
You didn't
Are we
cover those?
going to cover that?
No, I'm not going to cover that.
Okay.
No, guys, it's tricky to know what to cover and all this stuff, but well, I'll be honest with you, there's one other presentation that I'm going to be doing with you guys that does cover some other stuff. We might touch on that. I've forgotten now, but I'm not going to cover it here. But I was focused solely on this. I am honestly trying to remember. I haven't looked at this particular PowerPoint for about 3 weeks. I can't remember if that was in there, but I don't think it is.
It's in our, for the 2017 tax year, it's in that chapter on 15. So that's the only reason I asked.
I got you. It's a fair question.
I
It's
took good
a fair
notes on the
question.
reading, too.
Well, I don't remember seeing that question, but this is kind of a guesswork as to what to cover and make sure we can cover everything. But there's some things which I have chosen to skip over, and I am being honest with you. I don't remember if I covered that or not. I don't think I did because I don't think it's in this other one. I'll be able to tell you once we go to it, though. Okay. Any other questions about the Affordable Care Act? No? Okay, give me a moment. All right, so we're going to just do some questions here. John is 37 and Kelly's 38. They're married, but they file separate returns. They have 2 dependent children, Nadia, 11, and Greg, 14. They all lived together until April 30 of the tax year when Kelly moved out. The children stayed with John. No one else lived with them. John completed an 8332 for Kelly to claim Greg as a dependent. How many members are in John's tax family for the premium tax credit?
No, no one. MFS.
Yeah,
Sorry.
I agree.
One only. Yeah, no one. Why is it 1, 2, 3, 4?
Guys, that would be pretty. Would you really file them MFS? Either of them?
How many members are
It
in
says
here?
filing separate returns.
Yeah, they are. They're not filing together. That they
would
didn't.
be-
They did not say that was their filing status. They said they're
You-
filing separate returns.
So John could be
Ah.
HOH. Yeah, because they're
Okay.
together or separated for more than
Oh, the kids
more
stayed
than
with
6
John.
yeah.
I see.
Yeah. So, how many members are in John's tax family? This is getting into that somewhat confusing stuff that I'll be honest with you, even I have trouble keeping straight. But just think about it.
4.
Pardon me.
4. They all live together until April 30 of the tax year.
No, it's not 4. It's not 4.
Yeah, until. Sorry, I just read.
3?
Nope.
It's not 3. Okay.
I understand why you'd say 3 because that's the error I would have made. It's 2. I'm
Well,
going to
if
give you
he's
the
paying
answer.
for insurance for Greg, even though he gives the 8332 to April, wouldn't he still
8332 means
claim
it's
Greg
probably-
for the premium tax credit?
Yeah.
That's what you're asking, right? I
Yeah,
mean, most
yeah.
likely, if
Yeah,
they live
John,
with him, he's
I'm going to
covering
give you.
insurance.
I'm going to give you the explanation, and this is where I'm relying on somebody else who created this question because I think they're right, and I think I may have misled you slightly, and I apologize for that. John and Nadia, so John and his daughter Nadia, are members of John's tax family. Kelly is not because they're not filing jointly. She's
Yes.
filing her own return. Greg is not because he's being claimed as a dependent. So somebody earlier asked if you're claiming a dependent, are you responsible? The answer is yes. So I had that backwards even in
Thank
my
you.
own thinking. Okay.
Okay.
Okay. So I think Tina was the first one to say, well, I thought it was the other way and I was misleading you and I did not mean to. So no, you would. Confusing to me because I know of a real life situation where it wasn't this way, but I think something else was affecting it where we were dealing with IRS. So that's what's confusing me. So guys, let me clarify for everyone watching this after the fact too. Mistake in what I said earlier. The person who claims that dependent, that's part of your tax family. But there are situations I want you to know where you can have somebody in your tax family that you might have to account for on your return. Okay? Okay. So let's look at another one. Brenda's 41 and not married. She has a dependent child, Bruce, who's 2 years old, and 2 dependent cousins, Jerry, 15, and Ben, 16, who lived with her all year. No one else lived with them. Brenda does not get any additional benefits for claiming both of her parents. So she does not claim Ben on her tax return. How many members are in Brenda's tax family? 1, 2, 3, or 4? And you can just speak out your answers. This is kind of a group effort here.
3, wouldn't it?
I'm going to say 4 because he still lives there.
Guys, I don't blame you. It's 3.
Yeah. 'Cause
Brenda's-
she's not claiming Ben.
Right. I'm going to read you the exact explanation coming from the expert in this
married.
field. Brenda's tax family for the PTC, for the premium tax credit, is not the same as her tax household for the shared responsibility payment and health care coverage exemption. This is stuff we haven't covered, and this is what I was hoping was going to be covered in your reading, and I don't think it is it? Has anybody read that chapter?
It was.
It was? Okay. Was it covered? Okay. So what we're all, myself included, right now are getting confused a little bit is tax household for shared responsibility payment and for the health care coverage exemption. Okay, so that for the shared responsibility payment and healthcare coverage exemption has a slightly different definition than tax household for premium tax credit.
Mm.
There's what we're getting confused, and I think that's where I got confused too. So my apology. We're all learning this a little bit better together. Brenda, Bruce, and Jerry are members of Brenda's tax family. Ben is a member of her tax household, but not her tax family, because she's not claiming Ben. Okay, so here's the difference.
So would she be responsible for covering him with Medicare?
Yes, that's what we're getting confused. So remember, for the shared responsibility payment, the extra tax, if somebody in your household, a member of your tax household, is not covered, you're going to get penalized. She had to have Ben covered, otherwise she was going to get penalized because Ben is part of her tax household. But for premium tax credit, they use a different thing called a tax family. For premium tax family, it's you only get to claim people you claim on your return.
Okay.
Does that help? That's what I'm learning from this, and it helped me to clarify that.
One I'm asking a while ago to you.
Yes. Yeah, I know. That's why I said there was some confusion there on my part. So make a distinction between, are we talking about tax household, which it has a definition of everyone living in your household. That's only for the
Health
responsibility pay. That's only for the responsibility payment. Tax household, responsibility payment. Tax household goes with responsibility payment. I mean, I'm saying the words tax household definition. Tax household goes with responsibility payment. Tax
for the penalty.
That's right, for the penalty. Tax family, different
For
term
the
for the PTC, for the credit. So it's important we keep that straight, and that's where I was getting confused too. So for the tax family, Ben is part of her tax family because he lived there.
Yes.
She would have ended up paying a penalty whether he was on her return or not. Right?
Okay, yeah.
Right. Now that helps with those other questions we had several minutes ago too. For the premium for the tax penalty, then it doesn't matter. You're still responsible to make sure you, as the
head of household,
head of household, or to be a little more accurate in this case, to be the parent. No, hold on a second. I'm trying to get the right term out. The custodial parent, you as a custodial parent, is going to be responsible for everyone living in your household. That is your tax household for the penalty purposes only. So you're gonna get penalized if Ben, in this example, if Ben doesn't have health insurance. But if he does have it, you're not going to he is not going to qualify you for the premium tax credit, because that's a different definition called a tax family. Tax family is who's on your return.
Okay, but it says right here, the wording in this question says Brenda does not get any additional tax benefits for claiming both of her cousins. That's Jerry and Ben. So she does not claim Ben on her tax return. So that,
right, but she still claims the other one.
She's not claiming him as a dependent. So
that's correct.
Even though she lives with him, she's not claiming him as a dependent.
That's
so
right.
She wouldn't get a claim for the premium tax credit. But
exactly.
It sounds like Ben's going to file his own return, is what it sounds like.
At 16 years old? No, I doubt it.
Okay.
No. You're reading a little too much into it. You're right up till that last sentence.
Okay.
Yeah, no, you're right on everything else.
Okay,
though.
I'm just making sure because some of what you were explaining confused me, so I just want to make sure I was reading that right. So
yeah, and I apologize, guys. It's because I'm always trying to keep this stuff straight too. And then they're always messing with it. You know, every year since this has passed, they've always tweaked definitions and everything. So It's made it harder. All right, let's go on. Lenny is 52. Diane is 50. They're MFJ. Their earned income and AGI is $62,498. They have one dependent child, Fred, who's 18, who lived with them all year. Fred's earned income and AGI are $3,207. Fred is filing a return to get a refund of the federal income tax withheld from his wages. Lenny, Diane, and Fred do not have any tax-exempt interest or exclusions of deductions of foreign earned income or housing. How much are Lenny and Diane's household income for the PTC? So what is...
Wow.
Okay, don't get too overwhelmed by this.
65,705.
So you have to add it in,
That's what I
add in
did.
the 3207.
It's part of the household income.
I'm gonna say D, 65,705.
I'm trying to understand
Household
some of what you
AC.
guys are saying. That's all. I'm just processing what you guys are saying. Okay, what they're asking, I want to clarify. What's their household income for the premium tax credit?
Okay, so that would just be their income, 62,498.
Yeah, that's
I
it.
would think it would be 62,498 because I don't think you would include the 3207.
No, there are the reason all this is in here is because you do have to know what a dependent's income is, because there are circumstances where you do have to include a dependent's income. That's all.
But he didn't make enough for the year to have to
Yeah.
file, so he's just
Yeah.
getting a refund. So that would exclude it. Okay.
Yeah, yeah.
Okay.
So that's all. They're just testing you if you knew that, hey, just use their income. That's
Well,
all.
I said total income, so I just added them
I
together
know,
right
guys.
after that.
Guys, these are meant to be.
Sorry.
Yeah, no, it's exact. No, Garrett, you're fine. I'm actually thinking about what you're saying because you're spot on. If he had had to file a return, if Fred had to file a return, that income would have had to been added to their income for purposes of the premium tax credit only. Okay, so if he had to file a return, then there would have been an answer D with the amount of his income added in there. Does that make sense?
So I'm going to ask a question about this in a different way. What if their son Fred, because he's their dependent and he didn't make enough to qualify to file his own return, and they just claim him as a dependent, can he get a refund without filing a return? He'd have to file a return.
No, he'd still have to file a return. No, the
Yeah.
question is he required to file a return?
Yeah,
He's not required to, but he can.
He can. That's not going to make this includable. Is he required to? Is he at that dollar amount that he's required to file a return? That's when they start including it.
Okay.
In fact, I would encourage him to go file his return. He's probably got a couple $100 refund coming.
Yeah.
Should. That's still not going to change this answer.
Okay.
Okay?
Yeah.
All right. So we want to match terms in the definition by drawing a line from term to definition. So we're going to take one at a time. APTC. Read the definitions and tell me which one goes with APTC.
APTC goes with the top one.
Top one.
A refundable credit designed to help the taxpayer.
Just to make sure we're clear, let's call in the definitions A, B, C, or D. And before we answer any more, APTC, does anybody know what that stands for? The short.
Advanced Premium Tax Credit.
Advanced.
Right.
Mm.
Right. Okay.
That's a refundable credit. That's why I chose
Right,
the
but I
top
want you to carefully read all the definitions because
Well,
you guys
I
have
did read
yet.
them.
No,
So,
it
yeah.
would be the payments made to the taxpayers.
Directly.
marketplace
That's what I
insurance.
think too.
So is it A, B, C, or D?
B.
Okay, I'll go B.
Yeah, B.
Consensus here.
I want you to do consensus because since consensus led you guys to the right answer.
Yeah.
Coverage family. Remember, we just distinguished that what we were making a mistake on. So
C.
C.
D.
D.
Taxpayer, their spouse, if MFJ, and any individual claims as a dependent on the return if they are enrolled in the marketplace qualifying plan, not healthcare coverage. Ooh, coverage family.
Okay.
Yeah, but that makes sense based on what we said. So premium tax credit, you guys should know what this one is now.
Yeah, A.
Yeah.
A.
And guys, A and I can absolutely see why you said it, advanced PTC was A because it really is part of that, but I just wanted you to look a second time. And then tax family, taxpayer,
Okay.
spouse of MFJ and any other individual claims as a dependent on their return.
Yeah,
This
yeah,
is what we
that's
were
for
just talking about.
PTC.
Tax family is who's actually on your tax coverage, and that goes with PTC or the penalty.
Huh?
The definition for tax family goes with premium tax credit or with the penalty. Remember, there's different. There's difference between a tax family and a coverage family.
Yeah.
Which goes
Tax
with
family
which?
with
Tax family goes with which of those?
the PTC.
PTC.
PTC, the actual credit. Coverage family goes with
Penalty.
penalty. That's just important to keep straight. Are we good on that one now? That we kind of all got our heads straightened around on those two different definitions? Good?
Uh-huh.
Yes.
Okay. Stewart is 33, single, and has two dependent children, Laura 10 and Meg 6. Stewart enrolled in a qualified health plan through the marketplace because he is, I can't read this on my screen,
Not
is
eligible.
not eligible for other eligible coverage. Laura
Minimum
and
essential coverage.
yeah, fair enough. Laura and Meg have health coverage under CHIP. How many members are in Stewart's coverage family?
1.
3.
Bingo. No,
Mhm.
it's no, you were right. You were both kind of right. We're not talking about coverage family. The taxpayer, their spouse, and any individual that may be on their return if they are enrolled in the marketplace and not eligible for coverage someplace else. See that?
Mhm.
That's why it's not 3. Did that make sense there, Garrett?
Yeah, because the two kids are qualified for the CHIP, so they're
There you go.
they're
Bingo.
basically
That's exactly
covered by
what. Yep. That's exactly why.
Medicaid. So
So the
okay.
only one that's really qualified under
Stewart.
is Stewart under the coverage family.
Okay.
Yeah, that's exactly why. So Carla's 25, Paula's 24, and they are MFJ. They have one dependent child, Jude, 1 year old. All of them have qualified plan coverage through the marketplace. Carl could have obtained affordable minimum essential coverage through his employer, but Paula and Jude are not eligible for coverage under his employer's plan or any other minimum essential coverage. How many members are in Carl's and Paula's coverage family?
2.
Did I hear 2?
Yeah.
You're right.
I'm gonna say 2 as well.
Yeah. Again, coverage family is who's available to be in the marketplace that's could potentially is or could potentially be on your return, who's living with you, who could be in the who is in the marketplace and not available for coverage someplace else. So we know, who was it? Carl. Carl could have gotten coverage, so he's excluded. That leaves us with only Paula and Jude.
Paula and Jude.
Yep.
Paula and Jude.
Good job. All right, who wants to read this one for us? I'll let somebody else read for a change.
Edward and Julie are married and always use MFS as their filing status. Neither one is a victim of domestic abuse or spousal abandonment. They do not live in Alaska or Hawaii and do not have any dependents. Their total household income is $48,600, $21,100 for Edward and $27,500 for Julie. And they have qualified health insurance coverage through the marketplace because they did not qualify for other minimal essential coverage. They did not receive any APTC. Do you, Edward and Julie, qualify for the PTC?
No.
No.
Just waiting for some other answers.
Yeah, because the MFS
Yes.
status.
You guys are right on. Yeah, all that you guys, they were actually trying to trick you there. They were trying to throw that MFS and see if you noticed that none of that rest of that mattered. As soon as you
I
saw
saw that, I was like,
yep,
nope.
yep.
So-
You're right. You're right. Good job. All right, who wants to read this one? Thank you, Tammy, for that. Who wants to read this one?
Farah, 43, is single. She lives in Hawaii and has one dependent child, Nathaniel, 12. Her total household income is $75,487. She and Nathaniel have qualified health insurance coverage through the marketplace because they do not qualify for other minimum essential coverage. They did not receive any APTC. Does Farah qualify for the PTC?
Okay. You guys need a little bit more information than I realize that they didn't give you here. You'd have to look up, well, I'm going to give you a little hint here. The federal poverty level for family size of 2 in Hawaii, okay,
Yeah, is what?
is 18,430.
Well, the answer would be no.
Then no.
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 And you guys are right. They should have given that to you here. Only reason I have that is because I haven't
know
an
that that's
answer.
above the poverty line, don't you think?
Well, but yeah, above the poverty line. But when you start saying 400% of federal poverty level, I mean, you're getting up there. What is 400% of this poverty level?
73,720.
Yeah, 73.
So it's not much
720.
above.
73,720.
Yeah. So it's not much above, but it is above. So
Yeah.
Yeah, it's. Yeah, it's not much. I was just looking at the numbers. Yeah, it's not much above, but you see how much 400% of federal poverty level can be. But you also notice that puts most people, 400% of poverty level puts most people within the middle income bracket. So, okay. All right. So somebody hasn't read yet. Would you read this?
Sarah's age 27, filing status is single. Her only income is from wages of $9,705, which is less than the filing threshold for her filing status. She is enrolled in a qualified health plan through the marketplace because she's not eligible for other minimum essential coverage. She received APTC to help pay for the premiums. Is Sarah qualified to file Form 8962?
Okay, and just to clarify, is she required to file? That's the question. You said, is she qualified to file? It's okay.
Oh, sorry.
That's okay. Trust me, I do lots of reading. How many times you guys got me? So, okay, is she required to file?
Yes.
that form,
No.
Calculate the amount of credit.
Yes, because she received advance payment.
I would say yes. Yeah, she's required to file that form if she chooses to file. But her income's at a
I've got
status.
just
Her
about a
income is
different
too
answer.
low.
of every. Okay, let's ask
don't
this
think-
question. Two different things here. Is she required to file a return, period? Forget the premium tax credit for a minute. Is she required to file a
No.
return?
No.
No.
Her income's too low.
Is she required to, okay. What's
You can
one of
file
the,
to get a refund of her taxes paid though, so she probably want to do that. So,
Well, she's not required to, though.
but she's not required. Yes.
it's okay, guys. I want you to work this out because you're asking all the right questions.
She is required to file Form 8962 because she received advance premium tax credit.
I agree with Noemi.
You're exactly right. Because she got advanced premium tax credit, think this through logically. She got advanced premium tax credit. What form is she going to receive?
1095A, Form 1095A.
That's right. And if we said if you ever get a Form 1095A, we
It
said
should
you
be
have to,
attached.
yeah, you've got to do a tax return because you have to balance
Attach.
that. Yeah, you got to attach it. You got to balance for it. You got to account for the amount the government paid and the amount you pay. So this is one of those exceptions. If you go back to one of our early sessions, whether you have to file or not, you have to file when there are additional taxes to be paid or stuff like that, because this is one of those exceptions that have to be included in there. So is she required to file Form 8962? Yes, she is. She's actually not required to file a whole Form 1040, believe it or not, to be technical. Just let you know. Would I do it that way? No, but she is not required to. She could actually just, in her case, file just the 8962 to do the balancing and call it good, the reconciling. Just to let you know. So the question is, that's why it asked, is she required to file Form 8962? Make sense why she has to file?
Yeah.
It's just because she had advanced premiums tax credit. Anytime anytime you are in the marketplace, you're going to get a 1095A. Anytime you get a 1095A, whether you took the advanced premium credit or not, you're going to have to file a Form 8962. Okay.
Okay.
Who, I forget who hasn't read yet.
Noemi.
Noemi.
I cannot read because it's not
Oh, she's
coming
still
up
waiting.
to me.
I'll
All
read
right.
it if you want me to.
Okay, Amanda, go for it. Thanks.
If the taxpayer's advance payments of the premium tax credit exceed the premium tax credit calculated on their return, the taxpayer may have to repay the difference. Is this true or false? I'm going to say true.
True.
Okay, got
True.
2 votes. True. Okay, 3. Tammy, did you put in your vote yet? Oh,
Me true.
true. Yeah, you guys are right. It's true. Advance premium tax credits are paid by the government. If those are higher than the credit should have been, then you got to repay the difference. Or you may have to. Keep in mind, those are generalities. You actually use the form to calculate what you got to pay. All right. I need somebody to read this. Anybody can pipe in and read this one.
Kevin and Stacy were married 10 years ago. They have 3 dependent children, Brandon 8, Gretchen 6, and Marshall 4. In January of the tax year, Kevin enrolled all 3 children in a marketplace qualified health plan with an effective coverage date of February 1st. Kevin and Stacy divorced in July. The children became eligible for and enrolled in government-sponsored health coverage effective August 1st. Kevin claims Brandon and Gretchen as dependents, and Stacy claims Marshall as a dependent. Does the PTC shared policy allocation apply?
Okay.
Good grief.
First of all, I know there's a lot of info. I'm going to help you with this one, okay? First of all, did you guys in your reading, again, remember, I have not read your particular textbook. Did it cover shared allocation? Does anybody who's read that chapter
I don't
recall
think it did.
Okay. Shared allocation. It's okay. We're learning it here then. Shared allocation is talking about when there's a divorce in the year, it can mess up the tax family and all of that, for purposes of doing this. So there's some special rules in that situation where you can share some things. So short answer is yes, it does. Because of the divorce, they could share it. So can somebody tell me, based on what you're reading there, I want to know tax family, okay, tax family, who's in Kevin's tax family? Who's included in Kevin's tax family? This is something extra here. Remember, tax family goes with premium tax credit. So who's in Kevin's tax family?
Kevin, Brandon, and Gretchen.
The 3 children.
That's Kevin, not the 3
Kevin
children.
plus the 3 children.
Oh boy.
Not Marshall, because Marshall.
Kevin
is
claims
in
Brandon
Stacy.
and Gretchen.
Kevin claims Brandon and Gretchen. You're correct. So who is in Kevin's tax family?
Kevin, Brandon, and Gretchen.
That's exactly right. Kevin, Brandon, and Gretchen. Remember, we're talking tax family here for the premium tax credit. And Stacy claims Marshall. Who's in Stacy's tax family?
Stacy and Marshall.
That's right. That's right. So, not to worry too much about this question. I seriously doubt you'd get it. All right, one more here. Andrew is 24, Gwen is 22. They got married in September of the tax year, and they're filing a joint return. They had not been married before. Andrew was enrolled in Marketplace Qualifying Health Plan all year and did not receive any APTC. So he was in the Marketplace. He did not get advanced PTC. Gwen is enrolled in an employer-sponsored plan. Do they qualify to use the Form 8962 alternative calculation for marriage?
Yes.
Okay, there's no way you would know this. The answer is no, but it's only because there's no APTC payment that was made. Look, these are exceptions to the general rules that they're trying to get into. I cut those out when I went through my presentation because I think it's too much detail. I remember when I put this together, and this was about a month ago, I put this together. I left it out because I think it's more detailed than you guys really need to remember. Just try to remember there are some special rules. I doubt you're going to get tested on it. And I think you guys just told me nothing about either of these last two questions was even in your reading. Am I correct?
Oh, they didn't. Mm-mm.
Yeah, so
I
I'm
didn't
not too worried about it. Really not. Really not. Okay,
Wait,
so
but I did
Huh?
a return like this. Oh,
Yeah.
never mind. I've got it. It's because there was no APTC. That's why. Otherwise, because I filed
Yeah.
the 8960.
And guys, I'm going to tell you the truth. I would have gotten that last one wrong myself if I had done it without being able to see the answer. I'm not look, there are different experts that write certain things. Some things I did this shorthand version of this because I thought it was easier than the way they taught it. I thought it was much cleaner. But I did, of course, the danger is I cut out some of the detail. But there's only so much detail a person can remember anyway, right?
Yeah.
Okay. So we are finished with the Affordable Care Act.
Yay.
Yay. Yeah. And that would take care of Chapter 15, I believe it is, for you.
Yeah.
And we do have another section to cover. It's called taxes and payments. It's where it's kind of a generic thing where there's some miscellaneous taxes, and that's the one that I did not remember if your question about some of the other taxes would be in there. I honestly don't remember. It's been too long since I've gone through and culled through that section. We can either go through that now, or we could take a break right now, or we can do a third option, and that is we could also go and call it quits for today and pick it up on Monday. If excuse me, what is today? Friday. The next session, we could pick it up the next session. Where are you guys at with your studies? This really more has to do with you. The people here are the ones, plus a couple others that cannot ever be here live. They're watching this. I want to give you guys a chance. Do you need more study time? Would you rather have the time to go and read and take some quizzes, or would you rather push through another session today, or another session today?
Push through another session.
Okay.
Because you know what, when I took the first exam in the online,
Yes.
I failed because some of the topic were not yet discussed. So I think it's better to complete all the unit before taking the exam online.
Yeah.
All the units, yeah.
Okay.
I'm nowhere near ready to take an exam online.
Okay, but keep in mind you can take
Partly.
questions just from the chapters.
Right.
And that's what really I want you to
go to the chapters.
Yeah, that's what I would do. That's what I would be doing, Noemi. Really, for real. This is how I'm studying for the EA course. I was in part 2, but I was going into the individual chapters, reading it, participating in whatever videos were available, and excuse me. And then I was doing the quiz questions for just that chapter. Okay. Does that make sense? Just that chapter. And what I'm asking everyone to do is do chapter 1. You've already hopefully read chapter 1 and participated in the video, this video interactive, or watched it anyway. Once you finish chapter 1 and watch the video that goes with it, and I'm talking about this here, the PowerPoint, what we did here today that's been recorded, then sit down and go through the quiz questions for chapter 1 and go through them again. I take them over and over again till you're getting 80% or better 2 or 3 times in a row. Then go to chapter 2 and repeat that, so that by the time you get done with all the chapters, you've gone through hundreds of questions for each, or several questions for each chapter. You've gone through hundreds of questions. Then and only then do you start working on what I call the test questions. You throw it all together into one big amalgam, and you might get them in any order. That's what I'd recommend everyone do. That's how I study, and it works. Okay. Does that help?
Yes.
Okay. So, Sheila, I know you're about to go. Hold on just one moment. So if you can, just give me another 2 minutes. So everyone, it sounds like, based on what I'm reading and everything, that most people would prefer to go ahead and call it quits for today.
It's okay with me.
Yeah, but that's the only reason, because Noemi, what you bring up, I'm glad you brought it up. Please go back and take just questions